Let's talk about what it takes to start investing. Several factors influence the future development of the investment. How old are you and what is your investment horizon? What level of risk are you willing to take? Do you have money to invest? What investment products do you know and what appreciation do you expect? How old are you and what is your investment horizon? It's ideal to determine in advance how long you want to invest. Determine your investment horizon. Do you want to invest in the short, medium or long term? Do you want to invest for 5 years and capitalize on the money which you will then use to settle the mortgage? Or do you want to invest for retirement? The amount of age determines the amount of deposits. Are you 20 years old or 50 years old? Your age will determine how much you need to invest to reach your goal. Age determines the level of risk. If you are in your 20s, you can take more risk than someone who is 50. In your 20s, you have a lot more time to correct your investing mistakes. Age selection, investment product. And finally, the choice of products in which you can invest is related to age. If you are younger, it makes sense to use riskier products, and if you have 10 years until retirement, you choose more conservative products. If there were an unexpected upheaval in the financial markets, and stocks fell by 20 to 30%, it could mean that you would have to wait several years for prices to return to their highs. You don't want to do this a few years before retirement.
Nah, 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 no. Yeah. Oh, I can't let him take my soul. Nah, 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 no. Yeah. I can't let him take my soul. Nah, 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 no. Oh, I can't let him take my soul. Nah, 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 no. See, we was cool right before it hit the fence, but it hit the fan when I got him down and pinched. But I took a break, I had to leave and go get cleansed. God forgive me for all my sins.
What level of risk are you willing to take? Investing undoubtedly includes dips in the markets, recessions, and on the other hand, inflating and collapsing bubbles. All these market turmoils are part of investing and cannot be avoided. In 2000, there was a dot-com bubble when many technology startups were falling. In 2008, there was a global mortgage financial crisis caused by the sale of non-performing mortgages. In 2010, there was a flashback, a 36-minute washout in the markets. Blood was literally flowing. In 2011, the market fell due to the weak results in America and the debt crisis in Europe. 2015 saw a market sell-off that started in China due to the end of quantitative easing and continued with Greek debt and Britain's decision to leave the EU. In 2020 there was a market crash due to the panic surrounding the coronavirus. Currently, the US is facing a recession and Europe is struggling with an energy crisis and inflation. Markets are down 22%. What do the current stock crashes look like in 2022? Minus 73% Netflix, minus 44% Meta and minus 37% Amazon. So we should ask ourselves, are we willing to bear all the pitfalls of the markets? Will we not succumb to the short-term decision to sell when the markets are in long-term downtrend? We must remember that an open loss, if we don't sell the asset, doesn't mean a real loss. Do you have money to invest? In the long term, the stock market shows an average appreciation of 7%. This means that any liability that exceeds 7% in the form of unpaid debt or credit card debt represents a loss of value for our money. To invest, you need to get rid of debt. We can probably agree that paying off debts above 7% as quickly as possible would be a reasonable solution. You may ask, what about mortgage? Of course, a mortgage loan is one of the good debts and provides us with a basic life need, housing. We pay it off over the long term and the monthly amounts are low. Before allocating money to investments, you should have saved a financial reserve in the form of several monthly salaries. A washing machine, refrigerator, boiler, or car you drive to work can break down at any time. In the absence of a reserve, we would be forced to withdraw money from investments that have not yet had the opportunity to make profit. This is definitely not a good choice. Use only excess money for investments. What investments products do you know and what appreciation do you expect? We live in the information age. Information is valuable. For example, Google builds its business mainly on information. It's difficult for us to make decisions without information. In order not to run into fraudsters and to have an overview of the products on the market, we need to educate ourselves, sort through information and form an opinion. Education is not a choice, but a necessity. Should we choose product A or product B? Do we understand the product fee structure? Do we know the product development history? Can we compare products? It's a lot, but don't worry, it can be done. The rate of expected profits is based on the riskiness of the investment. If we settle for a low annual return, a product that covers inflation will be enough for us and we will most likely sleep soundly. But we won't earn anything extra. And conversely, the risk-return formula explains it perfectly. That would be all from today's video. If you enjoyed the video, please give it a like. More people will see it. For up-to-date market information, compare analysis, undervalued stock tips or calculators to calculate fair stock prices, I'd love for you to join my private community on Patreon. You can find the link below the video. Have fun and invest wisely.